Well, good afternoon and good morning for those from New York. Thank you for those joining the webcast or through the telephone call directly. Yeah, I'm gonna talk about four things. One is what we think has been happening. Secondly, what we have done since the 1st of February. Thirdly, how we are today and how we have been lately. And last, to share with you the potential opportunities or when we think we will be able to capture more aggressively those. Well, what we think is that we have been for many years in a world with quite negative fundamentals, which have been left in the sidelines. We were in an environment with low growth rates, huge tons of debt, which has been growing, and we have much more debt than we had in 2008, and with high valuations on the equity markets, mainly driven by this positive psychology that has been taken by central banks and authorities to all-time highs, driven by free money, buybacks, and central banks and government action. Just to have a quick review of the fundamentals, what we have seen is you may know more than 60% of the profits from the US companies have come from buybacks. In 2018, we saw a new record of buybacks on the US market, more than 806 billion, which have been funded with debt, and lately has been funded with offshore profits, taking, I would say, advantage of the fiscal policies from the Trump administration. As probably you will share, we think this amount of debt that the companies can take in their balance sheet is limited. No? So we are expecting for this buybacks to start to slow down and have an impact on profits, which actually you can see that revenues in general have been very mildly growing or even flattish, and it has been all these profits driven by cost cuts and buybacks. What we are seeing in China, we're seeing, I mean, this is a context that we have seen in the last years. We have gone from a debt boom to a debt hangover. There has been a deception regarding the demand on Western products on China. We like to say as US has a plan, but China had a plan too. So it had put a lot of barriers of entry into many of the Western products, which has developed with two consequences. Mainly, one, it has been this trade war with the US, and secondly, a German recession, which growth was mainly driven by China investment boom, and this has been slowing down continuously. In Europe, what we see is this problem with Germany, and a part of that, we see Europe with a hard currency, which probably only works for Germany and maybe France, but it doesn't work for the rest of the countries. And this is why we are putting this sentence of growth muted, apex, all pigs. Now, probably with this hard currency, most of the countries, we can consider them as pigs. So suddenly coronavirus appears. Coronavirus deeply hits into the heart of what is the confidence, the positive psychology that has been built during these years, and we have these huge drawdowns on the market. We think that that is a proof that most of the market was very expensive, and the size of the drawdowns just simply are giving us the impression that we were right, no? And that the market should have gone down, but the drawdowns are being so dramatically that I think are somehow showing they were priced, how overpriced the market was. Now going into what we have done since the 1st of February. If this red line is the Euro Stoxx volatility, and the gray line is our value at risk being consumed, the amount of risk that we were consuming on a daily on a daily data at 99% confidence. So you would see how since the beginning of February, we reduced the consumption of risk to more than half. This is mostly the reduction of our positions in the oil companies, but also we reduced a lot the gross portfolio, trying to wait and see what happened. I mean, we of course were not very sure that this was going to happen, but we were rather wanted to anticipate to be in a more comfortable situation. Since then, you can see that we have been keeping a quite prudent low portfolio, but where volatility has completely boomed up, and the markets, of course, have pressed down. So I think this is a way to show our flexibility and to try and move fast and try and anticipate problems. We have reduced portfolio. We are managing portfolios of around 30, 40, 50% gross with quite flexible nets moving between plus minus 15%, depending on the price actions. We set up a short position in what we called infra-virus companies, which was mainly infrastructure companies that were related to the movement of people and that could be hammered by the market. So mainly companies that are heavily exposed to the macro environment, toll roads, also airport infrastructure. And in general, that has worked quite well. Those shorts have protected us. As you know, many of the countries have established short bans for their stocks. So we have closed those shorts, but we have been keeping shorts in some of the utilities in Europe and shorting some of the utilities in other countries in Europe, which still have not banned that short. No? So we are shorting companies in the UK, we're keeping our Spanish shorts, and also in German and Denmark, and some part on the regulated names in the US also. No? We're shorting that. Why? Well, mainly we think there's going to be the pressure from the stock market has moved to credit, definitely, but we think also that is going to move into the sovereign bond markets. We think that is going to create run out of these positions on utilities, especially regulated utilities that have been used as bond proxies, and where probably the interest on them, and they're heavily owned. So we think we will have a chance there to be the next move where the selling flow can concentrate.